Good evening, everyone, and once again, welcome to the third quarter's Capital Market Review. Today's title is Exhuberant Times. Because we were so close to Halloween and trick-or-treat, I probably could have labeled it or titled it Market Tricks and Treats. This title is in reference to a comment that Alan Greenspan made in a speech referencing a book that year, 1996, Irrational Exuberance. I'm not suggesting that the market is prone for a huge pullback, but I am suggesting that things are beginning to look a little bit frothy, and we'll talk about that somewhat today. Why we do these is because we think the economics matter. What we want to do here is kind of dissect the growth rate in the economy, talk a bit about jobs, job creation, corporate profits, inflation or the prospects of inflation, and also what higher interest rates mean to the economy and investments in general. We do this in an attempt to identify kind of where we are and also to a large degree where we're heading. The idea is the economy will provide some telltale signs of economic slowdown, and that's often way before the market corrects. So with any luck, we'll be able to identify those and be a little bit more reactive to market changes. And the effort here is for us to kind of stay balanced, stay diversified, and of course stay invested. The four themes that I'd like to talk about for this quarter are the economy. We'll talk about markets, stock market, as well as the interest rate market, and also foreign markets. We'll talk a bit about the Federal Reserve, what their balance sheet kind of looks like now, and when, if ever, they may actually start to taper from this excess stimulus. And then we'll talk about asset allocation and how that may play out in the months and quarters ahead. So before we get into the markets, let's talk a little bit about just kind of where we are right now. Obviously, the market continues to grow a bit further. We are now at all-time highs. From a market valuation point of view, the PE through the third quarter was about 14.3. That isn't excessively high. Back in 2000, the PEs were 25, but that is considerably more than the PEs back in March of 2009 at about 10 times earnings. I do want to reference, though, at the previous market high, October of 2007, PEs were about 15.2. So from a valuation point of view, they're not what I would call exceptionally rich, dangerously rich, but from a valuation perspective, I would also say that they're not the bargain that they were 3 years ago. Interest rates, we've seen a big change in interest rates this last quarter. Interest rates are starting to move upward. The 10-year Treasury finished the quarter at 2.6. That's up significantly from where it was a year ago, which was much closer to a 1.6. And this move has nothing to do with the Federal Reserve changing their policy. They are keeping rates exactly where they've been the last couple of years. The short rate, the discount rate hasn't moved. But there's been talk of when and how the Federal Reserve will take back some of this stimulus and stop the quantitative easing. And as a result, the Treasury market is to a large degree an auction market, and buyers and sellers are not waiting around. So as a result, you'll see that they're demanding lower price, higher yield, and we're beginning to see those yields start to increase. On a inflation-adjusted basis, the yield at 0.8, that's the current yield less inflation, is still, in the general scheme of things, very, very low, very inexpensive. So it's not stifling the economic growth, but certainly this may be a little bit of a taste of things to come. Let's talk a little bit about fund flow too, because that's changed somewhat. Mutual fund as well as the ETF industry tracks flows going in and out of various investments. And what's really interesting is you can see going back to the credit crisis, this huge amount of increase in money being poured into the bond market over that period of time. Since this year, in fact, that all these changes are really this year, we begun to see where the flows are beginning to reduce somewhat, and at the same time, for really the first time since 2009, we're beginning to see positive flows in the equity market. In fact, you can also see this here, equity flows in excess of bonds, just been the last couple of quarters. So this whole market increase, 2009, 10, 11, 12, we actually had negative flows into equities. Now we're beginning to see positive flows for the first time, and that's, again, a multiple year change. And at the same time, we're still seeing flows into taxable bonds, but at a much, much slower pace than flows we've seen. The outflows have been really in tax exempt, in part because of some concern over Puerto Rican bonds and obviously what's happening here in the Detroit area, also with the default of the city of Detroit that has some concern over tax exempt, and you've seen some people reallocate out of tax exempt. So the economy is improving. Confidence is improving. We're getting more calls of clients who would like to take on more risk, want greater return, more equity exposure, and you generally see this when the market is fairly mature. We're not typically seeing that kind of conversation, not having that kind of conversation when markets are cheap and people are fearful. Valuations, I wouldn't say they're improving. They're not getting ridiculously expensive, but they are certainly not by any means cheap. So let's talk a little bit about the economy in particular and where things are. We've doubled the amount of output that was lost during the Great Recession. We put on $1.3 trillion of output to about a $640 billion of lost output. So by any measure, this growth over this period has been fairly anemic. GDP growth is 2.5%. You know, one of the reasons for that may very well be the Federal Reserve, and we'll talk about that in a second. Components of the economy, you can see improvement. Vehicle sales are still doing very well. We're now at a point where output is exceeding the long-term average. Housing starts have been improving. They slipped here a little bit. Part of that is this change in interest rates is having an impact on mortgage rates, and mortgage rates are becoming a little bit more expensive, so maybe that took a little bit of demand off the table. Manufacturing and trade inventories are very lean. That's good news, and actually they've been slipping, which is even better news. Greater turnover, and CapEx orders are stronger, certainly, than they've been. So all in all, this is not the signs of an economy that's rolling over. When you look at the weak economic growth, some of the reason for that is the sequestration that we've been under. If you look at this chart here, which shows the federal budget surplus or deficit as a percentage of GDP, if you look at 2012, which is right here, the annual budget that year was about 6.3% of GDP. The estimate for 2013 is 3.9. Yes, we're still adding to national debt. We're adding to national debt at a slightly slower pace. And that's because we've got better output. The pie is getting larger. GDP is getting larger, but at a slower amount. That drop in government spending, if you will, which is in some case what this is, was a huge negative impact on economic growth. Now, when you look at what 2013 looks like compared to the projection for 2014, it's an incremental drop, not nearly the drop that we saw here. So the biggest hiccup to economic growth occurred during the transition from 2012 to 13. So the expectation is we may in fact see greater economic growth going into 2014. Consumer balance sheets look great. Consumer balance sheet total assets, $88 trillion worth compared to about $13 trillion of liabilities. Household debt service has literally never been lower, 10% of income. And household net worth all in has been increasing significantly. In fact, that's a $12 trillion increase in just 2 years. So people are feeling wealthier. They're seeing their 401k balances, brokerage account balances, etc. improving. They're seeing home values improving as well. And as a result, consumers are feeling a little bit more confident. That may transcend into greater retail sales, although we haven't seen that yet. They're still very cautious. It also may translate into the wherewithal or greater wherewithal to take on a bit more risk, meaning move more assets toward equities. One point I found kind of interesting is right here, student debt. Student debt represents 9%. That's the percentage of consumer. That's percentage of consumer indebtedness. Student loans represent 9%. That number is actually greater than credit card and auto loans. So consumer debt has really come in quite a bit, and now student loans have overtaken. Europe is beginning to come out of this recession as well. We talked about this last quarter, and we're seeing continued improvement. In fact, if you look at these numbers here, these are PMI numbers, or Purchase Managers Index. Anything over 50 would indicate expansion. Anything less than 50 would be contraction. Not necessarily recession, but contraction. If we look at where we are through the end of September, the only European country that still shows any sign of red is Greece. Everybody else is above 50, indicating expansion. And that may actually help with our exports as well as European exports as well. That's a positive sign. Let's talk about markets. We know where the S&P is at effectively all-time highs. Not cheap, but not overly expensive. When you look at returns by category, the bigger the company, the less the return. In other words, the big movers this year have been mid and smaller cap stocks. Small cap have been on fire. They are by far not what I would call cheap by any measurement these days. Whereas large cap has had a good return, but a smaller return than small or mid cap, both from a year to date as well as a third quarter perspective. The returns so far within the S&P have been pretty well across the board. Those areas that have returned less than the S&P are certainly the more conservative areas. For example, consumer staples, telecom, utilities, and basic materials have all underperformed. Industrials, consumer discretionaries, healthcare, financials have all outperformed the broad-based S&P index. From a valuation point of view, as I said, it's not super expensive, but it's not a screaming buy either. Price to earnings, as I said, are quite a bit higher now than they've been over the last year, 3 years. They're slightly exceeding the 10-year average. Price to book, slightly higher than the last 3 and 5 years at 10-year average. Price to cash flow, more expensive today than the last 3 and 5 years. Price to sales, the same. And PEG rate ratio, or price to earnings to growth, also a bit more expensive than the 3-year number, not quite where we were 5 or 10. And part of the reason for that is earnings have grown so quickly. One, still positive, although again, not to the same extent as in prior quarters. Right here, the S&P's earnings yield is still significantly above the investment grade yield from Moody's. And whenever the earnings yield is above the investment grade yield, the market is not what we would consider expensive. When you look at operating earnings, profits effectively, they're continuing to grow, growing at a slower pace over the last year or so, but still growing and still continuing to add value. So if we're running a market 14 times earnings, and we have about 120 earnings, you can see that we're looking at an S&P that could be 1,800 or so. And you can also, or 1,680, if PEs expand a bit to 15, we're at about 1,800. If earnings can grow a bit beyond where they're at, there is some opportunity for some growth. Although we're getting into that area where the economy is going to have to start to expand for earnings to continue to expand. Valuations, as I said before, small cap are getting to the point where they're pricey. Large cap value, still really pretty cheap. The big blue chips paying stocks, still relatively cheap. The growthier side of the equation, a bit more expensive. Real earnings yield, again, still in the range where it's cheap, just not quite the bargain it was. Interest rates started to come up, and as a result, that's going to create some headwind going forward with respect to the market. It's already creating some headwind from the standpoint of balanced portfolios. If we're allocating to a number of different asset classes to reduce long-term risk, we're not 100% in stock. We are, for the first time in a number of years, starting to see interest rates rise, and as a result, returns from the bond market are starting to turn negative or flat. So there's a large percentage of a portfolio that is effectively non-functioning. When we look at on a 10-year yield today, 2.6 versus 1.65 a year ago, that's a sizable increase. For every 1 percentage point increase in a 10-year bond, we could see about on average with a 10-year maturity and duration, about a 9% decrease in price. Year-to-date return is down about 5.5% just since January, and that's net return, net of income. So we've got to watch this closely, because at some point, if interest rates continue to rise, we're going to see some real serious headwind in terms of balanced portfolio returns. I'm going to get back to the slide in a few minutes, but the point is not all bonds are created equal. There are a number of bonds that tend to have less correlation to the 10 or 30-year Treasury. As a result, they tend not to lose quite as much value in the event that interest rates do start to rise. More on that in a little bit. This graphic also kind of shows that the bond market itself is fairly diverse. Most bonds, most bond funds tend to index against the Barclay aggregate that used to be the old Lehman Brothers aggregate. In this slide, it's represented by the orange boxes. You'll also see other types of bonds and their performance. Those are the other colored boxes. As an example, high yield has given us still a positive return year to date, 3.7, compared to a -2 for the Barclays aggregate. Mortgage-backed securities are down 1. They're also performing better than the Barclays aggregate. But you'll see during certain periods of time, different bond categories outperform. The other thing I wanted to mention here is year to date, the average bond is down in value. And that's the first time that's happened in many, 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 many years. Up right here, 2008, when we had the credit crisis, they were down fractionally. That's going to be a surprise to many, as we've gotten very good returns from bonds up until this point. Let's talk about the equity markets from a global perspective. Things there are also beginning to improve quite a bit. And in particular, I want to show you the improvement we've seen in Europe. We talked about the PMI index. We talked about the improvement that we've seen there. Look at the S&P 500 year to date versus, let's say, developed Europe, 16 versus 19. But look at the big difference in the quarter, 5 versus 11 with Europe, 14 Europe x the UK, and Pacific Rim x Japan. All huge improvements compared to the U.S. market. And part of that is the dollar's been falling here a little bit relative to foreign currency. and in particular Europe, which has kind of helped their market kind of trump ours. So we've been slowly moving some money into Europe. Some of you may have seen some allocations. We'll be seeing more as this month we tend to do quite a bit of rebalancing. We think Europe in particular should bode well and could very easily outperform the U.S. Valuations are less, yields are higher, etc. From an economic growth perspective, this is encouraging. This slide, if we focus on the light blue, that represents the projection of third quarter, fourth quarter, first and second quarter next year. And whether it's emerging markets collectively, China, India, Korea, or developed markets, US, Canada, UK, Germany, even Italy, the expectation is we'll see an improvement in economic activity, economic growth going forward. That should help at least improve or give corporate profits and growth rates of profits a fighting chance to kind of stay even, and PEs stay even or potentially improve. From a valuation point of view, we've seen this chart before. The gray bar represents the range of equity valuations: high, expensive, low, cheap. The brown bar is average, and the diamond is kind of from a valuation point of view where we are today. You can see Germany is a bit expensive, France is kind of neutral, UK is a hair expensive. Other developed European nations look really cheap. Canada looks cheap as well. Japan also looks cheap. US kind of fully valued. From an emerging market perspective, Korea looks expensive, South Africa looks very expensive, Indonesia looks expensive, India looks cheap, they've got functional problems, Russia's cheap, they have functional problems. Emerging markets in general, inexpensive. When you meld all that together and look at US as well as international as well as other classes, the green box is the S&P 500. And you'll see the S&P year to date has been one of the best places to be. That's U.S. large cap. The only thing better was U.S. small cap. This is problematic from the standpoint of a balanced portfolio. If we want a balanced portfolio, because we don't want to take and have the big shocks, big downdrafts to the equity market, and we own things like real estate and bonds and emerging markets and commodities, all of these areas here have not performed well this year. Doesn't mean they won't perform well next year or the year after. But because of that, it's created a huge differential between what the S&P is performing at year to date and what a globally balanced portfolio is performing at. And that delta is about as wide as it's been in several years. Last year, 11 versus 16. This is ex-dividend. Flat to up to 12 versus 15. So you captured most of the upside with significantly less downside this year, and it might be a bit of the frothiness in the market, but we're leaving certainly some return on the table by being balance focused. In the alternative space, and this is kind of an interesting space, and we're looking at it a bit more closely because there might be an opportunity to replace some traditional bonds or traditional equities with assets in this particular space. For example, replace stock equity with real estate, or stock equity with natural resources, or private equity, or managed arbs, merger and arbitration. These are categories that frankly have absolutely little correlation at all with the U.S. stock market. So it's a way of getting exposure to areas that have the potential to grow, but with a bit less risk, a little bit less correlation to the U.S. stock market. Federal Reserve been active. Their balance sheet continues to increase. They continue to buy to the tune of $85 billion a month. On their balance sheet, they're holding, these are their liabilities, these are their assets. Their liabilities are bank reserves. And you can see banks are very comfortable leaving their reserves with the Federal Reserve. They're earning a bit of money, the discount rate. They're earning a bit more than they would be earning if it was sitting in or lent out as savings, etc. At some point, this is unsustainable. At some point, if interest rates do start to move higher, these assets will start coming out of the system. And then the Federal Reserve may have to start selling off some of their bonds. This has the potential to be a little bit disruptive. But then again, the Federal Reserve can just continue to hold these assets and use other means to replace the reserves. Economic growth has been slow. Inflation has been low, in part because the money multiplier has been very, very low. Money is just not changing hands. Normally, dollars will change hands 8 to 9 times in a healthy economy. Here it's barely 3 times. Unemployment rate's lower. It continues to drop. We've replaced 7.5 million jobs. We lost nearly 9 million. So the recovery has also been very slow with respect to job creation. When you look, we've added about 1 million new jobs a week, but then there's been 50 million separations out there as well. So the net has been very, very 20 million layoffs and discharges. As a result, workforce participation keeps dropping. There are a number of people who just stop looking. The only encouraging thing that I see here is average hourly earnings growth. Very robust. This continues. That could really, really help with respect to improvement here. People starting to re-engage in the workforce. Home prices continue to improve. Home inventories have backed up a little bit. That might have something to do with the mortgage rates. And the last interesting note here is, again, home prices have come up enough now that there's still a bargain. They're still cheaper than renting, but not quite as cheap as they were about a year or a year and a half ago. Let's talk a little bit about allocation. This was the slide I mentioned previously. The point is, in a lot of our portfolios, we have steered away from the U.S. Aggregate Index. The U.S. Ag, which is based on 10 and 30-year, the large percentage, about 40% of the Ag, is Treasuries. Very, very sensitive to interest rate moves. You start looking at high-yield debt, floating rate securities, which you may have noticed. We've added some of those to the portfolios. These things generally in a rising interest rate environment can still stay ahead net, and they also are a bond-based asset, so they will be a little bit less sensitive to stock market movement. So there are ways to structure a bond portfolio with assets that are much less correlated to the treasuries, and as a result reduce some of the sensitivity here to rising interest rates. This is the alternative asset slide once again, and my belief is certain asset groups here may provide us an opportunity to reduce some of the direct exposure to fixed income, and yet not increase risk by adding more exposure to equities. We talked about how Europe is beginning to perform. One of the reasons for that is right here. When you look at Eurozone, Korea, even China, their currencies have appreciated relative to the US dollar. So the dollar has actually depreciated, and when that happens, you will, when you mark to the US dollar, their stocks will have a tendency to outperform. And that's one of the reasons you've seen robust growth the last quarter or two. One point I want to make is volatility is surprisingly low. Normally we have a 10+% correction each year. With all the headwinds that we've had this year, the big concern over debt ceiling, etc., we've had a very, very little in terms of pullback. It seems like the market will pull back 3-5% and then immediately move back up. I mention that because pullbacks are generally normal, they're expected. With market valuations as high as they are, I'm a bit uncomfortable chasing stocks at these prices. We're looking at any weakness at all as a way of getting some cash to work. If we can buy on a pullback, we've got a greater opportunity to make money going forward than to bid up and pay high valuation for the same security, because earnings are also slowing down a bit. Doesn't mean the market's going to correct in a big way. It doesn't mean that we're expecting any kind of huge disruption. Could very well see higher values at the end of the year. But between now and then, would it surprise me? No. I just want to let you know that we're certainly watching for that and are willing to react if the opportunity comes up. I want to share this slide once again with you, and this is because of the general nature of allocation. The idea is, instead of being on this roller coaster ride, by having assets spread out among other areas, we can get a reasonable return with much, much less volatility. Let's make sure that that's kind of what we want. And for most of my clients, it absolutely is. The pain of a big loss is much worse than the pain of lost opportunity in terms of return. But this year in particular, because it's been sort of a one-trick pony, equities have performed, commodities, international or emerging markets, international and bonds have not. Having an allocated portfolio has left returns significantly less than the S&P 500, at least at this point. If we had a pullback next year or whatever, we'll find that the returns will probably be very, very strong. I mention that because sound investment management kind of begins with the management of risk, and one of the key methods of dealing with risk is asset allocation. And the reason's pretty simple. Another 50% loss means another 100% increase, and we just don't have that many more of those ahead of us. And for most of my clients who are retired or close to retirement, we don't have a 5 or 7 year period where we can claw back. So as a result, we want to take a bit of risk off the table. This is November, and as a result, we tend to look at rebalancing. We talked about moving some of the equity into international equity. And the reason we look at this at this point, there is some degree of seasonality in the market. Usually during the summer, the market pulls back. It certainly didn't this year, but it usually does. And the period of November through April is usually the best period of time for the market. It covers the last 2 months of the year and then the first 4 months of the year. Now, this year it might be a bit different. Remember, the debt ceiling debate didn't get resolved. That can just got kicked down the road, and we're going to take another look at that in the February-March timeframe. There is some reason for rebalancing in November as opposed to end of year or January. And again, that 6-month cycle. If we would have just invested and put money in the worst 6 months and then took the money out and put it in money market and then put it back in again during the beginning of the worst 6 months, and we did this for an extended period of time, this is 63 years, $10,000 invested in 1950 would be worth only $9,000 today. Conversely, if we invested in the best 6 months, took the money out, put it in money market, moved it back in, the same $10,000 would grow to $700,000. Now, why don't we use this as a strategy? And the reason is the return on the best 6 months was actually less than the return on the market for the full period of time. And the reason is, during this worst 6-month period, there were still 38 up periods and 25 down periods. The only difference is here there were 48 up and only 14 down. So what we do is we look at rebalancing a bit, repositioning, going into the seasonal strength with respect to the market. And as I said, pullbacks are natural. They're expected. The average inter-year decline with the S&P is almost 15%. And declines of 15% or less have very little correlation to a negative return for the full calendar year. So a 15% pullback is not out of the realm of possibility or expectation. With our ETFs, we generally put stop losses in at 15%, and that's the reason why. Best advice is always to stay balanced, stay diversified, and stay invested. Staying invested in a balanced portfolio over a multiple year period generally increases return the more asset categories you have and reduces standard deviation. That provides a smoother ride with better return. The other thing is the longer our time horizon, the greater the chances we'll have a positive outcome. Markets can be extremely volatile over 1-year periods. Over 5-year periods, there are few, but some that elicit negative returns. Fewer still over 10 and 20-year periods of time. So with that, I'd like to open up to some questions. And I've got a couple. One, I was anticipating this. What is the anticipated effect of Obamacare on the markets? It's tough to say at this point because there seems to be an awful lot of uncertainty with respect to the websites. Certainly, the auctions are not in place. The thought is, if those do become functional, the real issue will be, are we going to see a market increase in what the cost of health care is? If we do, then the question is, who bears the brunt of that? If it's the individual consumer, you could see a reduction in consumer confidence and perhaps consumer spending. If corporations continue to share cost, you might see a little bit less of an impact on the corporate side because they would have the ability to pass through some of the cost to consumers in terms of higher prices, etc. But I'm a bit more encouraged that maybe some of this confusion may light a fire under folks to maybe consider the funding of this or push back the actual enrollment and penalty period, and that might provide some debate to actually look at improving this program and actually vetting out the true cost. From what I've read and certainly conferences I've attended, it appears that the cost on the economy is certainly going to be greater than what the cost was when it was explained to us as to why we all need national health care. And that becomes a additional tax on the system. Now, can we grow out and grow the economy beyond the impact? We can, but if the economy slows up at all, this could be a negative. More on that later. We'll probably see the real effect of this 2014 and beyond. Another question, what is agency MBS? Let me just see if I can find that slide. The balance sheet on the Federal Reserve is really comprised of two large assets, U.S. Treasuries and agency mortgage-backed securities or mortgages. So effectively what's happening is the Federal Reserve every month is spending a little over $85 billion. They're buying, I believe it's $45 billion in treasuries and $40 billion in mortgage-backed securities. So they're buying A lot of loans and mortgages that either are new and have been originated by banks, or they're buying and taking certain mortgage obligations off of the bank's balance sheet. These could be bad or marginal loans, and now the Federal Reserve has them on their balance sheet. The impact of that is it's helped to suppress and effectively keep interest rates low, because the Federal Reserve is effectively holding a lot of these the mortgages, and it takes some risk off of the individual bank's balance sheet. So MBS is mortgage-backed securities. I want to thank you for attending. All right, I think everybody has seen the disclosures. With that, hey, thanks so much. Have a wonderful evening. If you need anything, give me a call. Good night.